The Intelligent Investor, by Benjamin Graham, is a widely acclaimed investment book that has influenced generations of investors since its first publication in 1949. Graham, considered the father of value investing, presents a comprehensive guide to investing intelligently and profitably in the stock market. The book emphasizes the importance of a disciplined and rational approach to investing, focusing on long-term strategies and minimizing risk. In this detailed explanation, we will explore the key themes and concepts covered in The Intelligent Investor. Introduction and Investor versus Speculator, Chapter 1. Graham begins by distinguishing between investors and speculators. He defines an investor as one who analyzes stocks as businesses and makes informed decisions based on intrinsic value. Speculators, on the other hand, engage in short-term trading and rely on market trends. Graham emphasizes the importance of adopting an investor's mindset to achieve long-term success. Mr. Market and Margin of Safety, Chapter 8-20. Graham introduces the concept of Mr. Market, an allegorical figure representing the stock market's daily fluctuations. He highlights the irrational and emotional behavior of Mr. Market and advises investors to remain detached from short-term market movements. Graham also emphasizes the significance of the margin of safety, which involves purchasing stocks at a price significantly below their intrinsic value to protect against losses. Stock Selection for the Defensive Investor, Chapter 14-20. Graham provides guidance on stock selection for the defensive investor, who is more risk-averse and seeks stability. He emphasizes the importance of diversification, focusing on large and established companies with a consistent track record of earnings and dividends. Graham introduces quantitative methods, such as analyzing financial statements and calculating ratios, to assess a company's financial health and value. Stock Selection for the Enterprising Investor, Chapter 7-13. The enterprising investor is willing to engage in more active investment strategies. Graham advises such investors to conduct thorough research, including analyzing individual stocks and industry trends, and to seek out opportunities where market mispricing may exist. He introduces the concept of net stocks, where the market price is significantly below the company's net current asset value. Market Fluctuations and Investing with a Margin of Safety, Chapter 8-20. Graham cautions investors about the volatility and unpredictability of the stock market. He advises against attempting to time the market and instead recommends focusing on long-term investments with a margin of safety. Graham suggests a dollar-cost averaging approach, where investors regularly invest a fixed amount regardless of market conditions. The Psychology of Investing, Chapter 8-20. Graham delves into the psychological aspects of investing, emphasizing the importance of maintaining discipline and controlling emotions. He warns against succumbing to greed during bull markets and fear during bear markets. Graham suggests adopting a contrarian mindset and being skeptical of popular market opinions. Bonds and the Investor's Attitude, Chapter 3-6. Graham provides an overview of bonds and their role in a diversified investment portfolio. He explains the various types of bonds and the factors to consider when evaluating their attractiveness. Graham also emphasizes the importance of the investor's attitude, patience, and ability to withstand market fluctuations. Mutual Funds and Investment Advisors, Chapter 2. Graham discusses the advantages and disadvantages of investing in mutual funds and the role of investment advisors. He urges investors to carefully assess the expenses, fees, and track record of mutual funds before investing. Graham also encourages investors to be cautious of advisors who may have conflicts of interest. Throughout the book, Graham emphasizes the importance of thorough analysis, rational decision-making, and a long-term perspective. He advocates for a conservative and defensive approach to investing, focusing on minimizing risks and preserving capital. While the book primarily focuses on stock investing, Graham's principles can be applied to other investment vehicles as well. The Intelligent Investor has remained highly relevant over the years due to its timeless wisdom and practical advice. However, it's important to note that the investing landscape has evolved since the book's publication, with new financial instruments and market dynamics emerging. Thus, readers are encouraged to supplement Graham's teachings with updated knowledge and adapt their investment strategies accordingly.